Coming up, the buyers paying cash for property, global interest rates continue to rise, and a downgrade for Australian and New Zealand banks. That's next. It is your daily 10-minute business and finance news wrap for this Thursday, the 8th of June, 2023. Later on market day, global interest rates continue to rise. But first to property, where a new report has found that along the east coast of Australia, a quarter of all residential property transactions were funded without a mortgage last year and at a value of $122.5 billion. For more, Rhayna Bosch spoke with Mike Gill. He's the head of research at Property Exchange Australia.
So I think your audience will be surprised by how common it is for property to be purchased with cash. So 1 in 4 properties in the East Coast were purchased with cash last year. So that means there was no home loan and no mortgage registered with the land registry. So I guess that begs the question, who are these people that are buying properties with cash? Now, we looked at the areas where we were seeing these cash purchases. And in most states, especially Queensland and New South Wales, we did see that skew towards regional areas. So when we looked at those areas, you see areas that have higher median ages. We have less folks who are in the workforce, and we see predominant household types of couples without children, so the kids have left home. So that really talks to downsizers, it talks to retirees. They've obviously sold the family home, they might have paid off the loan or have a small balance on there, and they've been able to use those proceeds to then go ahead and purchase a property. So it is your typical green change and sea change that's driving a lot of these cash purchases.
Now, Mike, that 25% figure does sound relatively high. Can you just explain how people are actually achieving this?
So I think it's intuitive that someone who's had a mortgage for some time might have had paid that down and obviously benefited from rising property prices. So that downsizer story is quite intuitive from that aspect. But if we flip the coin and we look at younger demographics, so younger buyers who've bought recently, obviously they've paid higher prices for properties. They've had to take out larger loans to be able to fund those purchases. So in this environment of rising interest rates, it's that group that is most impacted by those interest rate rises. So their already high mortgage repayments are going up, and they're certainly feeling that pain. And you contrast that obviously to a retiree who's buying a property cash. They're not exposed to rising interest rates at all.
Mike, another key finding from your review was that a large percentage of these purchases are actually from international backgrounds. Can you talk us through this?
Well, that's right. So there was that theme around downsizers and retirees moving to the country to retire. And that's where the volume came from. So more than 50% of cash purchases fit that profile. But what was really fascinating was when we looked at the areas where there was the most money being spent on cash purchases, so value, that was very much the urban centres. So looking at the top postcodes where we saw the most cash purchases, they were Broadbeach in the Gold Coast region and also Surfers Paradise right next to Broadbeach. And between the two postcodes, last year, over $2.5 billion was spent on property and purchased with cash. So significant numbers there. We also saw in the southern states, so in Sydney, the top postcodes there were Mosman, so an affluent inner area within Sydney with over $700 million worth of cash purchases. And Darling Point also featured. And then we also saw in Melbourne, some of those affluent areas, Toorak and Brighton appear right at the top of the ranking. So that's really driven by obviously more expensive properties in those areas. But it does tell the story that there are a lot of well-heeled buyers who have plenty of cash on hand to be able to purchase expensive properties in these areas.
Mike, outside of the regions, we've also seen an uptick of purchases in city areas. Can you talk us through who's driving that?
We did see a lot of evidence to suggest that was being driven by both local investors, but also overseas investors as well. So we know that a lot of off-the-plan apartments are marketed to investors in those areas and also marketed offshore as well. And we are seeing cash purchases coming through those channels. And again, when you look at the demographics that live in those particular areas, inner city Sydney and also Melbourne, there's a really diverse mix of backgrounds. Looking at the ABS census data, there's plenty of folks living there who have parents who were born overseas and a diverse range of backgrounds. So we know that those areas are very attractive to overseas buyers. And we know that a lot of those properties do ultimately get leased out. There's strong tenancy markets in those areas. So local investors leasing out, or potentially overseas investors having family or their kids stay there.
And finally, Mike, I know it does take a long time to build up the type of capital that you would need to make a cash purchase, but what else does this tell us about the generational divide between people buying houses?
I think this sort of data and research has implications for policymakers. So the Reserve Bank is obviously making decisions around rate rises. This data really points to the fact that it does, really impact younger borrowers more than it does potentially older borrowers. And it gives us a sense of where these cash purchases are also taking place. But more broadly, when we look at industry, it gives industry, lawyers involved in property, real estate agents, a better sense of who's, how properties are funded and bought. And I think more broadly, from a consumer perspective, it's just really interesting, isn't it, to know that 25% of properties are bought with cash.
That is Rhayna Bosch speaking with Mike Gill, the Head of Research at Property Exchange Australia. Now, Market Day on the SBS On the Money podcast. Well, the Australian share market did fall today. The S&P ASX 200 down by 0.26%, 7,099. That's amid global rate concerns, with tech and real estate stocks performing worse. For the details, I spoke with Henry Jennings, a portfolio manager at Marcus Today.
Well, I guess a lot of it is to do with the fallout from that, surprise interest rate rise that we saw from the RBA on Tuesday. The market actually started off June in quite fine fettle, but since then we've gone back to that fear about further rates and the repercussions, of further rate increases. And last night we also got the Bank of Canada raising their rates to a 22-year high of 4.75% and saying there is more to come. So that is the danger. The market has taken all of this quite, not hugely bad, but certainly not in a great frame of mind following a few good days as we kicked off June.
You mentioned the Bank of Canada overnight. Next week we've got the US Federal Reserve. What's the market thinking in terms of this move higher with interest rates around the world, and is it changing the way you're investing at all?
I don't think it's changing the way we're investing. I think the market's still very cautious. A pause seems to be the forecast now, the consensus forecast from most of the economists in the US. It is becoming a bit like a triple jump with a hop, skip and a jump, but a pause or even a skip could be the way of things next week, and the Fed could sort of just pause for the summer, wait for some more data to come out. There is some big data due after this meeting, and then of course we will be focusing on Jackson Hole, which is a big gabfest in August in the US, where central bankers get together, and it was a pivot point last year. It was quite significant last year, so that will become the focus as we head into July in the markets.
I saw an interesting note today from the guys over at Fitch this afternoon, lowering its outlook for the banking sectors in both Australia and New Zealand to deteriorating from neutral. In Australia, it says net interest margins peaked late last year. What's your take on the banks at the moment, especially as you mentioned the RBA lifted interest rates earlier this week and with the potential for more rate rises to come?
Well, I think at the moment the banks are in a sort of a wait and see mode. But certainly we saw yesterday the Westpac CEO talking about the hardship hotline, certainly getting a lot more calls since the recent rises that we've seen. Up till March he was talking about, and now we're in June, so I'd imagine that's continued. So that's clearly an issue for the banks. Interestingly, today I saw some figures saying that a quarter of the purchases of houses on the East Coast were done with cash. no mortgages at all, which is quite extraordinary when you think about it. Maybe that is downsizing at play. But certainly, the banks are trying to tread a very, very thin line between keeping people in their homes, obviously, those hardships that are around, and also trying to create new business and making money at the same time. So it's not an easy time to be a banker, I don't think, at the moment. And there's certainly some stresses and strains on their books.
Is it an easy time to be an investor? Where are the opportunities at the moment?
Well, I think the opportunities are, certainly we've seen the opportunities in AI-related things in the US, although that is starting to fade. It is also starting to fade a little bit here. Not that we have any NVIDIAs or those sorts of stocks, but there are certainly some opportunities here. But I think it's time to be a little bit cautious, and certainly the volumes in the market are showing that there is still caution around. It could be a long, hot summer in Europe and in the US. We've seen the bushfires in Canada. But it could be a long, hot summer for them and a long winter for us in terms of just waiting to see what happens as we head into what could be a recession on the horizon.
Henry Jennings there from Marcus Today. Now, Market Day on the SBS. This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.